Thank you. Okay, good afternoon, everyone. Thank you for joining us. This is our first webinar for the Smart Wealth series. My name is Pedro Saya. I'm the Managing Director of Faraday Venture Partners here in Portugal. We're having this series of webinars, like I said, the Smart Wealth. We will be having other seminars regarding other issues of wealth management. Let me just share the screen here. Yeah, that should be good. So like I said, we are going to have other webinars regarding other asset classes and other issues of wealth management. We already had two previous webinars which were held in Spanish and were made available on our website. Should you wish to have a look at them or share with some friends or family, you're more than welcome to do so. We also have a newsletter with curated content, not just for ourselves, but also for third parties. So if you're interested in these issues, just feel free to subscribe, and we'll be shooting some emails into your mailbox. That being said, some quick housekeeping rules. So everybody's mics are muted, so we avoid some background noises, somebody's dog barking or worse. Same goes for your cameras. All cameras are turned off, so we can run this smoothly. That being said, if you have any questions during the webinar or at the end on the Q&A, we're going to save some few minutes at the end so you can make all questions if you want. We encourage you to do so. You just simply put your pointer at the bottom of your screen, and a menu should pop up. There's a Q&A button. Just press that button and type your question. I'll be screening the questions, and we will try, me and João, to go through as many as possible, but for time and management's sake, it's very likely that we won't be able to go through all of them. So a little bit about ourselves. For those who don't know us yet, Faraday Venture Partners is a private investors club. We provide access to individuals and wealth management and family offices to investments on early stage startups. There is no capital commitment to do these investments, so each investor gets to choose the investments they want to invest in. They don't get exposure to the investments that they don't wish to. That being said, Faraday Venture Partners takes care of all the heavy lifting, from the deal flow generation, screening the startups, the analysis itself, the investment structuring and management, and the company growth until its exit, and we close the loop of the full investment cycle. We have 227 partners in 3 different clubs so far, in Spain, Germany, and here in Portugal. We're planning to open in other countries pretty soon. We invested around 12.5 million in 28 different startups so far. We have 3 exits and 9 partial sales. These partial sales are actually secondaries. So whenever we can, we provide liquidity events to our partners. So if they, again, it's their option, but if they have the chance and they want to cash out their positions before the exit itself, sometimes we give them the opportunity to do so. We have a net IRR of over 15% so far. Again, we say over 15% because, of course, we cannot make a time to market instantly right now. So last time we did the maths, taking into account the last rounds, we had this figure. Of course, we know today for a fact that the several of our portfolio companies are worth much more than that. So those 15% will be higher for sure. We have 7 people on our team and a track record of over 8 years. And then we have co-invested with over 20 VCs in several different countries. And we held more than 30 events, which is something that we really like to do. In very shapes and forms. We do roundtables, we do networking events, we do workshops or webinars such as this one. These events are usually exclusive for our club members, but every now and then we like to open our events to the whole community. So with no further ado, I'd like to present today's guest speaker. We're going to have João Caiano sharing his insights with us. João is a CFA and executive partner at Task Wealth Management. He's also a vice president of CFA Society here in Portugal. And he has extensive experience on these issues, but let's hear it from himself. João, welcome, and thank you very much for accepting our invitation to join us today. It's a privilege to have you here. Could you tell us a little bit about yourself before we jump into the questions themselves?
Okay, thank you, Pedro. Well, and thank you everyone for participating today on the call. Basically, I'm almost 25 years of financial and market experience. Working more than 20 years in big private banks, both in Portugal, Switzerland, and Luxembourg, and then mainly in the wealth management, private banking, and mainly dealing with asset management. Either being an analyst, a portfolio manager, or a chief investment office with a big team of analysts. That was almost my last job in Switzerland in the private bank. And then 5 years ago, together with two founding partners, and a bunch of founding partners from Portugal, we set up Task in Switzerland. And so for the past 5 years, I've been working for Task, being one of the founding partners of the company. And we basically, our main business is wealth management. And I used to say, that's just what we like to do, is managing mainly liquid instruments. I always say, when people ask me a little bit, who are you, what we did, I think the main advantage, the very strong point that I have on my background is basically all the crises that I've been gone through. I started in '95, just after the tequila crisis in Mexico, and then '97 with the Asian crisis, and 2000, the internet bubble, and then of course 2008. Up to 3-4 months ago, I always said that 2008 would have probably been the biggest crisis I've ever seen, and work in the business. And of course, markets have this tendency to surprise us, and economies have also this tendency to surprise us. And now I think we're facing, the biggest crisis of our generation, of us. I think this crisis will be remembered in the next 200, 300, 400 years for sure.
Well, picking up on what you just said, having you gone through all this crisis, how do you compare this one with the other ones in like 2000 or 2008?
Look, I think you can compare this crisis with the other crises, and mainly 2008, because up to now 2008 was the biggest crisis you had. And but this virus, when it hit in February, of course we had the first news coming from China in January. But when it hit in February, late February, when all of a sudden, this was not only a surprise, but it was a dimension of this virus, of the impacts. I think no one could have imagined in a matter of days, a country like Italy would be completely shut down for almost 2 months. So you had basically revenues from companies coming from 100 to 0 in a couple of days. So the shock was huge. In 2008, it lasted, it started in 2007, if you remember, with the credit crisis, and then in 2008 with the financial crisis and the market crisis also. So it lasted for long, it was a long crisis, and of course, the harm that it did to the economy was huge in terms of job losses, in terms of company, failures. I think the biggest difference in this crisis is that it was much more severe, or it is much more severe at the moment, but it was very quick. It was very hard, but very quick. As I said, companies went from 100 of revenues to 0 very, very quick in some sectors, and other sectors went from 100 to 30. But so I think that it was very hard, but the ability of this crisis to destroying permanent jobs and permanent companies, failures, in some ways it's limited. It's limited to the quick reaction that both central banks and governments had and still have in those economies, meaning that if governments and central banks keep acting very quickly and putting a lot of money on the table, I think the capability of avoiding a mass destruction of companies and jobs is still feasible, meaning that we can recover, I would say, very, very quickly. I think when you compare this crisis with the previous one, you have to probably go back to the 30s, but then both you and me, Pedro, we only know these crises by books, by reading books. Yeah. So, so one thing is that when we enter this crisis, most of the economies were in very good shape. You look at the United States, permanent job, there was almost no unemployment, so economies were main developed economies like China, like Europe and like the United States, they were very, very good shape. And now all of a sudden, just, 2 months go, and you see GDP falling 20-30% on a quarter basis. And the best estimation so far, according to Bloomberg, is that probably world GDP will fall between 4 and 5% in 2020. On the other hand, the world wealth has not declined that much, or at least yet. You have to see the property prices. Let's see what happened to the property prices in the next months, because you don't have this immediate impact that you have on equities, on bonds. So let's see. But at the moment, the wealth did not decline as much. So there's a lot of savings. There's a lot of cash to be invested. The intervention from central banks, it was completely different. In 2008, central banks were very slow to act. They basically, you remember in 2008, you had the Bear Stearns case just in January, and then all of a sudden you had a couple of other banks almost in the failure. Merrill Lynch was bought by Bank of America, and then you have Lehman in 2008. So central banks were very slow to act, and all of a sudden, of course, at that time, the TARP program in November, this huge program of almost, I remember, 800 trillion went to the economy, to the markets directly. So I think this time was different. And if you see the interview from Philadelphia Fed government on 60 Minutes, he actually said that. He said that this time everyone was ready for this. The central banks were ready for this because they all have gone through 2008. And so they act very quickly. So all of a sudden you have all the central banks and the government deploying money. Fed balance sheet will probably go to 7 to 80 trillion in 2008, which is absurd. You were talking about reduction of balance sheet Fed previous to this, and now you'll increase the balance sheet of the Fed hugely. But then, of course, there's huge difference in terms of fiscal policy from country to country. You look at the US at the moment. The best estimate puts it around 7 to 8% of GDP. But then you go to some Euro countries and you see that, the fiscal policy aid coming from governments in some countries, even less than 3%. So there was, there'll be a lot of diversion in terms of, how the countries will react when they start to recover, which I believe they're already doing that. One thing particularly is that in this crisis, banks are not the solution, are not the problem, sorry, they are the solution. And mainly in Europe, because in the US, most of the companies, they fund themselves on the markets. But in Europe, it's different. Most of the companies, they fund themselves. They have to access funding from banks. So it's very good that, banks are solid at the moment, and they were in some ways ready for another crisis. I don't think at this dimension, but they were ready. And if you see, the crisis hit final February, beginning of March, completely different from what happened in the previous ones. And now we're already seeing the recovery, because reopening you only talk about reopening at the moment. I think I'm going to be a little bit strong on this. I think reopening cannot go wrong. This reopening cannot go wrong. We cannot have a second wave now. I think we can have a second wave.
I'm sorry to interrupt. That being said, there are several experts that might think that we have some sort of W-shaped recovery, because of the opening might lead into an increase in contamination, and hence a couple of steps back in the lockdown, which would lead to a slightly downturn, like a W-shape.
Yeah, look, there's a lot of discussion if this is a V-shape, a U-shape, an L-shape, or even a Nike shape, using the Nike logo, or a W. I think that most important is this first phase of reopening cannot go wrong. We cannot have a second wave now, meaning that I think that countries now and people are a lot ready. For example, give you a very small example. You have, for example, in Portugal, there's a town that for the past 2 or 3 days has 0 cases of infected, So I'll ask you this question. What is the risk in a town who has 0 infections for 3-4 days? Imagine 2 weeks, 3 weeks, all of a sudden people go to a restaurant or people go to a shop. So, so I think that at the moment, countries are already ready for a second wave. What I mean that second wave cannot happen now is that I don't think we will ever, I'm going to be a little bit strong. I don't think that we'll ever see nationwide shutdowns again. It will not happen again. I think if there is a second wave, even now, the reaction from countries and from governments will be different. They will attack it immediately, but very focalized on the region it happens, on the place it will happen. In order to avoid, we cannot have a shutdown again. We cannot, that cannot happen. One thing interesting is, of course, people are slow to recovery. You know, you open restaurants, you open shops, and you know, people tend to be slow because, of course, it hits them very well. They are 2 months, you know, in lockdown. You know, all of a sudden that you tell them that you can go to the beach, you can go to the restaurant, you can go to the shop. So I think yes, people are slow to recovery. But on the other hand, if this crisis doesn't hit so much in terms of job losses and in terms of company failures, you might have something like revenge spending, which is you're 2 months in lockdown in your home, and all of a sudden you can go out, you can go shopping, you know. And so if you lose your job, and if you didn't lose your company, you know, if you keep having revenues and start having revenues, I think, you know, consumption will be back in the economy. So I think recovery. It's interesting to see that in terms of macro numbers, you're already starting to see some recoveries in macro numbers because, of course, now remember that the fall was so huge. The base level now is very low. So at the moment, you start to see recovery. For example, yesterday PMIs in Germany, you know, even today the IFO numbers this morning with a strong recovery in expectations. So now we are discussing already, you know, what can come wrong. And so you're starting to see scenarios of disinflation, stagflation, inflation. I think at the moment, of course, you're seeing disinflation, you know, so prices are lower now. I think afterwards you probably see some stagflation, you know, because the economy is recovering very slowly. And of course, I think inflation will be a subject that everyone will probably be discussing. I would think probably more in 2021 than 2020, because with the amount of monetary stimulus and government, you know, spending that you have at the moment, you know, some discussion about inflation will have to, and it will be a question mark, you know, will we have inflation, you know, significant inflation? I don't believe that, but I think it's something, because you might have some disruptions in terms of production in certain parts of the economy, you know, like in the food industry or, you know, in the auto industry, you know, because of failures, because of, you know, substitute products. So I think that could happen, but I think it's something to watch out, not immediately, but in 2021. The other thing is that when the crisis hit, in the previous crisis, there was not this, you know, global crisis in every country in the world. And now we had a crisis all over the world. Every country got hit. Of course, some more than others, but also on the other side, you have to see that there's going to be a lot of divergence coming out this crisis. And of course, it's dependent on, you know, the amount of money that each country is helping its own economy. So I think that you'll probably see in August, September, some countries will probably enter what I call the panic mode, meaning that they will realize that the amount of aid they've put in the economy isn't sufficient. You know, and so they will need to come up with new ways of helping, you know, the economy. So I think this recovery in the beginning will depend a lot on the transfer of money from public to private, you know, and so things like, you know, debt aids from countries, things like countries starting, you have the Lufthansa trade just yesterday, and so the, you know, governments entering the capital of companies, you know, I think it's something that we will probably see in the future. So look, I'm quite optimistic in terms of I think that we will have a recovery. Will it be a U-shape, L-shape, V-shape? I'm not very, you know, I'm not spending that much time looking at this. What I see is that we've hit so bad now, you know, the base that we hit in terms of a falling GDP is so hard that I think now the recovery is inevitable.
It will be sharp.
Yeah, look, a lot of people are talking about the R in terms of the infection rate. What is the R? You know, what is the R? Is it above 1 or below 1? But no one is discussing the R in terms of the recovery, in terms of economic recovery. Because if you have an R above 2, all of a sudden, you know, the economies, they start to recover very well. And then you see that the private sector will probably use some savings. You know, there's a lot, as I said, you know, even Bank of America just came out a few days ago saying the amount of cash that's on the sidelines is huge, you know. Other thing to look at it is the interest rates. You know, I tend to say that interest rates will remain low for a very, very long time. And what you see at the moment is that central banks are targeting interest rate curves. You know, they basically making sure that interest rates on the medium to long term they stay low. Why? Because, companies will have to fund themselves on affordable rates. You can't have companies funding themselves at interest rates of 8, 9, 10, 11, or 12%. So at the moment you're seeing is both central banks and governments are targeting the yield curve, and that's why you see the Fed buying bonds on the market and the ECB buying bonds, and then of course you see some difference. I see that the Fed is a bit more aggressive than the ECB. But why? Because again, I said that, in the United States, the companies, they fund themselves more in the market than the US.
Picking up on that, we just sorry to interrupt. We just got a question from the audience, which connects with what you're just saying. So he's asking, do you believe central banks will be able to effectively act on inflation anytime soon, considering most huge companies don't rely on borrowing, have loads of money, and no need for major investments, as they mostly provide the materialized goods, as in Google and Facebook and so on?
Yeah. I don't believe central banks will target inflation very quickly. I think they will leave inflation for the next phase. I think at the moment, central banks are very worried into normalizing markets and making sure that the money is being put at hand for the companies. So I don't think that central banks at the moment will be targeting inflation. I think they will probably, because if you look at it, with the amount of debt, we can talk about the consequences of this crisis immediately, but with the amount of debt that you will end just after, in 1 month's time, 2 months, 3 months' time, a month of debt coming from governments and coming from companies, basically, I think the main worry at the moment is central bank is making sure that the money is delivered to the economies. So, and if you have a little bit of inflation, it's good because, remember that the debt is nominal, so you have inflation means, revenues will increase due to inflation. So I think central banks at the moment will probably leave inflation on the sideline, let's say, and hopefully I think it will be good to have a little bit of inflation now. Of course, I said it just about a few minutes ago, it is a risk because you cannot afford all of a sudden that inflation starts to pick up very aggressively. And as I said, I think that could be a risk in 2021, but I don't think at the moment central banks will target inflation at the moment, So one thing important when still comparing the crisis, is what are the major consequences of this crisis? We talk already about two of them. The first one, of course, it's the huge amount of budget deficits that you have: US, Europe, Japan, China. I think it will be good that this budget deficit is not, it's marginally financed via taxes, because Pedro, we come both from a country, that had a problem like this in 2011 with sort of huge budget deficits, and all of a sudden what you had is this huge amount of increase in taxes, and what basically it killed the recovery, and it took much more long time to the country to recover. So I'm curious to see how this budget deficit will be financed in the medium to long term. I think borrowing from private sectors, of course. And in Europe, I think the monetization thing will have to be again on the agenda, And let's see what this plan from Germany and France. There's already a lot of opposition here, but let's see what comes out. One thing that worries me a little bit is the presence of governments in the economy. You now during this phase, you have a huge presence of government in the economy. Governments at the moment are deciding everything. I think almost the democracy was a little bit put on hold for a couple of weeks, So you start seeing government being present in every major sector. And as you know from history, when governments start to gain control, it's very hard for them to give back the control to the private sector. Yeah, it takes a long time. And I think governments will take this opportunity to really look at their strategic, dependence in terms of sectors, which are the sectors most important, and they will select which companies they will help, they will select which sectors they will intervene, and you're seeing that already, for example, in the airline industry in the US and in Europe already, But I think that, a lot of good news also is happening. I think productivity will probably be higher, technology from one hand. I think, all of a sudden people are using technology on a completely different way. So I think in terms of productivity, that will help. Even the homework thing, people working from home. I myself am working from home, remotely for the past 2.5 months. And the other day I was discussing, how does it change? It changes a lot. I think, for example, speaking for myself, I think it gives me the ability to be more focused, because I don't have, as you know, when you're in office spaces, open space, people come in the morning, they discuss about football, they discuss about, the news, Bloomberg, and you get interrupted a long time. So I think in terms of,
commuting as well.
Yeah. So I think the productivity will help. Even these Zoom meetings, I know you know more than I, that sometimes when you go to meetings, you spend a lot of time and you don't focus yourself on what you need during the meeting. And so I think that even doing this remotely, sometimes it helps. So, and then of course there's, a lot of social changes, the mobility thing, how will be mobility? There's a lot of things discussing already in terms of mobility of people, like, electric cars, electric scooters, public transports. And on a negative side, I would say privacy. Privacy definitely is weakened. At the moment, I would tend to say that everyone is controlled. So that will be one of the probably negative things coming out of this crisis. But I will just end this first question, a long question, sorry.
Yeah, correct.
With remember all this, that people have short memory. People have very short memory. So it is very quick to think about these things, and then all of a sudden, a lot of them actually do not happen. Because if all of a sudden you start to see the economy recovering very, very quickly, I don't think it's going to happen like that. But if you start to see the economy recovery, people tend to forget very, very quickly.
Thank you very much for this framework. And picking up of that, before the COVID, we were already talking about the recession. Now we are talking about an eventual depression. So taking into account that the first one is already a fact, how do you think we can still skip the second one?
I think the second one has to be avoided. We cannot have a depression. I think the recession, as you said, is already a fact. We already have a recession in, technical recession in all major economies. So I think avoid by all the central bank and all the government intervention. And I think they will do everything. The ability, and I think they will do everything to avoid it. Because a depression and a long depression, because normally depression is a very long one. If you have a long depression economy, the amount that it will destroy, the job losses, the company failures, the use capacity of the economy will be permanently destroyed. And you have to avoid this. You have to find a way to avoid a permanent destruction of capacity used in the economy. In order to be able, the economy to recover it, I wouldn't say quickly, but to recover it. So I think that, of course, the reopening is crucial. As I said, you cannot have a second wave now. What I mean a second wave is you cannot all of a sudden the number of cases start, to go up very, very quickly, and the countries they go back to March. They say a lot. You have to go back home again, and confining measures. I think that for sure we would have a depression. So I think that countries will start to reopen. I think central banks and government will probably increase. I think we will have other programs coming from central banks and from governments in the next couple of weeks. I wouldn't put it months, but weeks, until probably the summer. And if there is a second wave coming up, I think governments, as I said, governments and people will be ready for it. They have all the measures. Even the very simple things. You didn't have masks, for example, for people to use it in the streets. So at the moment, all of that is already, already in place.
Better prepared. Yeah, definitely. Thank you. So consider a diversified portfolio with the four main asset classes being equities, fixed income, real estate, and a bit of alternatives in it. What do you think would be the short-term impact on the portfolio such as this one, and also for the medium to long run?
Look, Pedro, the short-term impacts that we have were huge. And I wouldn't say in terms of the dimension of the falls, but I would say in terms of the correlation of the asset classes. Once again, like in 2018, but this was very concentrated in 3 weeks, you saw that all assets were correlated Absolutely. Equities fell, interest rates in government bonds went up, credit spreads went up, commodities, they fell also. So correlation was all over the place. When you build a portfolio, your main objective is decorrelate your assets, so the volatility of your portfolio is lower. And what you had in the first 3 weeks was a perfect correlation of all asset classes. And then also on the recovery phase, when you started, beginning of April, middle of April, you start to have the recovery of the markets. So there was also a perfect correlation. So I think the short-term effects were huge, not just because of the amount of negative returns we have in most asset classes. Asset classes that tend in the past were very, let's say, low volatility asset class, like investment grade bonds, for example. And all of a sudden the spreads that went huge. They were 40, 50, the iTraxx Europe, and all of a sudden they were above 100, in 2 weeks. Looking a little bit on, let's say, medium term, I say fixed income, I tend to say that, as I said, I believe that interest rates will be low for a very long time. And I think the yield curve will probably be very, let's say, controlled by central banks. And so I think the attraction of government debt from developed countries like Europe and US would be very low. So I would tend to say not be very interested to invest in government bonds for the next 3 or 4 years. As for investment graded bonds and high yield bonds, as you know, central banks are buying this instruments, both directly in investment grade bonds and indirectly in the case of the Fed in ETFs of high yield. I think that, the spreads now, they've gone about 50% of what they lost in the first 3 weeks of March. I think probably we will not test the lows that we've seen. I think that at the moment, central banks will not allow very much that the spreads will go higher very much, because otherwise, all the funding of the companies will be in question, because otherwise, companies will have a very high interest rate to fund themselves. So I think looking at fixed income, I think investment grade and high yield looks, let's say, a little bit interesting on a medium to long-term basis, even taking into account that you're going to have defaults. I don't know what the default rate will be in the next couple of 3 months, But if you have default rates going to 6, 9, 10%, I think spreads at the moment on a long-term basis, and even adding some volatility that we can have, I think they look interesting. As for in the fixed income also, emerging market credits, for example, as I said, emerging market countries, they suffer a lot. Look at the case of Brazil at the moment. It's one of the worst markets in the equity space in the last 2 months. And so I think on the IMI credit, you have both the spreads going up, and then you have the currency effect. Most of these currencies, they lost a lot versus the dollar versus the euro. So the amount of debt increased in this time. So I think it'd be more hard for these countries to recover. But of course, at some point in time, you're going to find that these spreads are also interesting. I think maybe a little bit too early yet, but we'll have to wait. As for equities, I think that I wasn't expecting this recovery to be so fast, of course. I think no one was expecting, you have equities going down a lot, and then all of a sudden, in April, they start to recover, and they recover so quickly. 2 or 3 things about equities is that I think that earnings expectations look a little bit optimistic. But if you look at the S&P 500, almost 50% of the earnings come from 2 sectors, which is technology and healthcare. And both these sectors, they didn't suffer with this crisis. On the other hand, you had companies with results even better than they had previous to the crisis. Second thing about equities is that cash levels are very high. I said it about a few minutes ago. When you had that report from Bank of America last week saying that cash levels at the moment are very high. And if even don't take into account these last 3 weeks, go a bit back for the past 3 or 4 years, all the monetary expansion that you had in the last years, CapEx did not follow the monetary expansion. So there was not that much CapEx that followed the amount of money that was available in the economy. So I think there is still a lot of money available in the economy to invest. And I think this will benefit equities on the long term. And then people say, well, look, the S&P is now down 8% year to date. Yes, but have you looked deep into the index? If you go deep into the index, you see the dispersion between sectors and between companies is huge. For example, gold companies are now up year to date 45%, but airlines are down 60%. So I think the index probably doesn't reflect what's really happening in companies and sectors, because then you go to companies and sectors and see there's a huge dispersion in terms of returns. So I think that I was reading a report from Julius Baer last week, and according to Julius Baer, the equity risk premium at the moment is around 5%. So I tend to say that equities look interesting on a medium to long-term basis. It's very hard if you ask me the question where I think it's now the correct moment to invest. I find it hard to answer that question, but I say on the medium term, I think that equities look very interesting. I think probably they are the best asset class to invest on the medium term leg. And then you have to think again in that question between US equities and European equities, and I would tend to say that all that it's happening in Europe, you would tend to say that, of course, US equities look a little bit more interesting on a medium term basis. So I read a report about someone I like very much, which is Stephen Yan, who was a former Morgan Stanley strategy, and he says, I look at equities now on 3 steps forward, 1 step backwards on the next few months, and somehow I tend to believe. Being said that, I don't believe that we'll probably test the lows in March again. I think that probably the low March are probably the lows now, and probably we'll see the market recovery, of course, with some down turns. I think a lot of people tried to time the market and they sold, and now they have a huge problem, Pedro, because basically they want to reinvest, and now they are catching a train that is moving fast, and they don't know where to catch that train. So I think that's a problem, and so I think that we'll probably see that equities look probably will be the best asset class, in the next couple of years, in the 2 to 3 years. I don't have a clear view about real estate or private equity in terms of asset class. It's not it's not one of our major asset classes we normally invest. We tend to invest a lot on liquid assets. But one thing I'd say is that when you have long-term interest rates low, close to zero, or even negative, I would tend to say that property prices should not decline as much. Because normally you have cash flow. It's normally a cash flow between, I would say, 3 to 4 to 6%. So I think that, of course, there will be a readjustment in prices. I think property prices will probably fall in the short term, but I would tend to say that on a medium-term basis, I don't see a reason why, with interest rates so low, long-term interest rates, I don't see why property prices should decline as much. Gold, a lot of things about gold. I always tend to say that gold should be a part of a portfolio, but 2019, 2019 and 2020, I don't like that much gold, just for one reason, because it is a lot correlated with equities, and so at this point in time, when you're adding gold to a portfolio, if you don't have gold, you're not at the moment you're not diversified. That doesn't mean that correlations will probably break in the next couple of months, but at the moment, I would tend to say that gold will be will still be considered, let's say, a safe haven and then the question again, will we have inflation or not? If we have inflation, normally gold works very well as an edge to inflation. So I think I've covered the sector, the answer regarding the asset class.
I was looking. I'm sorry, I was browsing through some questions from the audience, but I believe you answered some of them already. There is one here regarding the fixed income, and this person is asking, considering that it is expected that interest rates will remain low for a long period, as you mentioned, what implications do you see for traditional fixed income investors such as pension funds?
Oh, of course, for a pension fund, it's a problem, because basically your liabilities, and your liabilities are on a long-term basis, and you have a lot of restrictions in terms of the amount on the fixed income side. What you invest in terms of investment of government bonds, investment graded bonds, and high yield. I would tend to say that pension funds will probably profit from this spread enlargement. And they will probably take some, and they are taking already, and probably change some part of the portfolio in order to benefit from the actual spreads that we have at the moment. Because if you know your liabilities on a long-term basis, and remember that investment grade spreads in Europe, for example, they were at 40 just 2 months ago, and now they're above 100. So what you have is the expected return of that bond on a long-term basis, it's higher than it was 2 months ago. So I think that you will probably see a lot of rotation in terms, of course, of the names they select to the portfolios. But it's an old problem. I think this pension fund is, in the United States, they're discussing the 401ks, the problem meaning that you have to watch out because probably when you hit retirement, your 401k will not be enough. And the problem is that if you keep interest rates so low for a very long time, I think, pension, I think if I'll be a bit more aggressive, there was this discussion about 4 or 5 years ago, which I think that, pension funds will probably have to increase their equity allocation. And they will. I think it's, with a risk premium of 5% on an equity portfolio, you will have to increase your allocation to equity. Of course, that will increase a little bit the volatility, which, and the manager of pension fund doesn't like that.
Trade-off.
But I think you will have to do that. I think you will have to increase the allocation to equities on that. Remember that allocation to equities on pension funds is very low.
Okay, interesting. So if you look into the next upcoming 12 months, what do you consider to be the main risks for the next year?
I think the main risks, as I told you, the first I already told you about, is the second wave now. I don't see the risk of a second wave in November or December. I think that, we will be ready for a second wave if it happens. I doubt even the World Health Organization even said something yesterday about that, believing that the risk of having a second wave is very low. So, but I think at the moment is the biggest risk I consider on the short term. I think the second one is the huge amount of public debt we'll have in 2021. How will we address that? Monetization, long-term issuing, I imagine the countries that will be profit at the fact that they have long-term interest rates so low. You will have to probably issue bonds at 50 years, 75 years, 100 years. You will have to do that. And with very, very low interest rates in order not to increase your, and they say, how do you do that? Well, you will have to do that with the help of central banks, So, but of course it is a risk because you will start in 3-4 months time, the amount of public debt will be huge. Inflation, I think we discussed a lot about that. I don't believe it's a risk at the moment, but it will be a risk in 2021. And the two other risks that I highlight is the euro crisis. Everyone's talking about the euro area, slowly to discuss, slowly to react. We've been discussing this plan for a long time. You have Germany all of a sudden deploying 6-7% of GDP in fiscal aid to the economy. And you have countries like Portugal, like Greece, like even Spain deploying amounts of fiscal aid much lower than. So once again, there will be a lot of diversion in terms of in terms of how the countries will react to the recovery phase. Of course, I will tend to say that Germany will react much more quickly. And so I think, let's see what comes out of this German-French plan. I would hope to have something very positive for the other countries, mainly the more indebted countries. And the last one is the China-US crisis. As you see now, these past few days, the tension has been growing between China and US. I tend to say that on the short term, China will benefit from this. On the short term, meaning that China has come out of this crisis very quickly. The economy looks to be recovering very, very quickly, and so China will profit from this. So things like buying assets in developed countries like Europe and the United States, I think something that they will try to do, or they will actually do it. But I think on a medium term, I think, you're creating something that, China was responsible for this. And so we have to avoid China. I think it will be impossible to do that, but it is a risk because, of course, you saw in 2018, if the tension goes very quickly, markets, remember this, Pedro, markets do not like uncertainty. And people, sometimes when I say this, people look, you're crazy because markets are uncertainty. No, but look at the last 15, 20 years, apart from the 2008 crisis, markets are not uncertainty. And why? Because, and it's one of the things I've been saying lastly is that I expect that volatility will be lower in the next couple of months. Why? Because the presence of central banks and governments in the markets, it's huge. So it limits the uncertainty. So if you have a tension between China and US growing very, very quickly, tariffs here, tariffs there, all these news lately that you have from listing companies in China and in the US, I think this will not be very positive. So I see that as a risk for the next months.
And considering this context that we've been talking about, would you think it would make sense to have a more frequent strategy investment analysis to change your investment strategy more frequently? Does it make sense? What's your take on that?
Look, I think that, of course, our strategic position in terms of our portfolio didn't change as much. I have to be honest, we were caught in the middle of the storm. So we were hit hard. We had our portfolios on a scenario that, growth will, GDP growth would continue. Of course, we were thinking that we were on the last stage of this bull market, but we were thinking that we probably would continue. And so we were hit hard. And we didn't change much our portfolio. Basically, we didn't disinvest, and so we maintained our investment on the several asset classes that were invested previous to crisis and allocation. Of course, we made some small adjustments, but once again, I think that when in 3 years' time, when you look back, I think this period will be very, very short and will be almost, let's say, of course, you will see it on the graphs, you will see it on the returns. But I tend to almost say that it will probably be irrelevant in terms of, medium to long-term profitability or of the portfolios. So, answering your question, I would say on the strategic side, I wouldn't change much what I was doing before. On a tactical, because for example, people are discussing a little bit in terms of, for example, countries to invest, sectors to invest, and I said, of course, you look at the technology sector and healthcare sector, they've improved, they've gained from this crisis. The performance was very, very good during these 3 months. But then I ask, when we enter the recovery period of the economy, will these two sectors perform as well as they've been performing in the last few months? I don't think so, honestly. I think it will be probably the sectors who got hit hard that will probably recover. Once the hotels start to open, once the airlines start to flow, and I think those sectors will probably recover much faster than the others. So I think changing a lot your allocation in terms of the big asset classes, and then the sub asset classes you invest in portfolio. Of course, we made some tactical changes, but overall, not as much.
Would you rather disregard any decision making on the
just one thing I like to highlight is that you always discuss this thing about market timing, and look what happened to market timing during this period. A lot of people sold, and now I said that before, and they are struggling to get in, because when will I get in? Okay, I'm waiting for a correction. But when the correction, of course, it will happen, the correction, but
you never know when. Yeah, well, we already went through this in a way, but is there any particular asset class that you consider that who will be able to come out of this crisis in a better or worse shape?
Yeah, I think I've answered your question. I think equities will be. I think equities, but once again, I think the investment grade bonds and high yield bonds, they look interesting. You have to be ready for some volatility. You have to be ready for some defaults. But once again, it's just a question which names you select or which managers you select if you choose managers. And that goes back to the question, active management to passive management. I think during this crisis, active management will probably gain a lot of weight because, you will have to select the names, you will have to select which asset managers, because some names will default, some names will not be default, and you think, but will that depend on what? It depends a lot. It depends on how important the company is in the country, how important the company is in the sector, how important the sector is. Why will you save an airline and not save a food company, for example? Imagine, or a renting company, like you had Hertz filing for bankruptcy this weekend. Why won't you help Hertz, and you will help Lufthansa, for example? So I think that investment grade and high yield also looks a little bit interesting on a medium term basis. But once again, I think equity for the 3 to 5 years to come, I think that they are the best asset class to be invested in.
I'm sorry, I was again browsing through the questions from the audience, but you already answered most of the questions, I believe. This one is already tackled as well. So let's jump into the next one. Taking into account the wealth management business as itself, would you consider that it would make sense to have some sort of concentration like we seen in the banking industry after 2008?
Well, that is a good question. What will happen to our business, in the next years? I think the easy question is saying that, once you have a crisis like this, it will be almost inevitable that you will have some concentrations. Companies buying other companies. Asset managers getting integrated to other asset managers. I don't believe that much, and I gave my own example. Task was created in 2015, just after a crisis that hits the countries at that time I was working with in 2011, 2012, Portugal. So I think that, you see a lot, for example, when we select assets, you can go to the big names and then you can try to find very good managers, or sometimes they leave big investment houses and they start their own asset manager, their small asset manager, which is, they don't manage 50 billion, they manage 200 million or 300 million. But if you're a good professional in a big organization, I think most of the time you're still a good professional in a small organization. So I think that when you have a shock like this to the economy, I think opportunities appear very quickly. And so I think that independence will be once again key, in the next couple of years. Independence in wealth management. I think the active versus the passive was something that, up to now was passive. Everyone was this, I think passive will be the future, almost that every active manager will go out of work in the next couple of years. I don't believe that. I think this crisis is a good example why we need active managers. So I would tend to say that it's very easy to say there will be concentration in the wealth management business. I would tend to disagree a little bit. I think that there will be opportunities, and I think that wealth managers will take this opportunity, maybe to go independent, maybe to start their own business, maybe to focalize in very small teams, and so I don't see that immediately as this will lead to a concentration in the wealth management business. I don't see that.
Okay, and as sort of wrapping it up, is there any other recommendation or insight that you would like to share to private investors, such as the ones we're having in our audience?
Yeah, I think that, as I said in the beginning, I always think I learn more when I get hit by a crisis, and 3 months ago, I said, to most of the people I used to meet with, I used to say that we probably will not live another crisis like 2008. And I always believe that because, most of the people who were in the capability of deciding, like central banks, governments, they all gone through 2008. So I always said, if the crisis hits the economy, they will be very quickly to react, which we were all completely surprised was the magnitude of this crisis. We never thought it would be so hard. So I think you have to remain calm in these situations, because I think the first reaction is to go into panic mode, and you start hitting the button, you start selling, you start buying. And I think you have to question your own scenario lots of times, because when the market has no volatility and the volatility is very low, and there is not much uncertainty in the market, it's very easy to take decisions, to increase your positions, to switch one position to the other, when there's huge volatility, it's very hard. And in the past, 2-3 months, the amount of uncertainty was huge. All of a sudden, where companies completely shut down, people working from home. So I think that you have to take some time and you have to question yourself, your analysis, you have to question, and I think having very radical opinions about, this is going to be a V shape, this is going to go down another 30%. I think you have to watch out a little bit in those decisions, and not in order not to rush in terms of the outcome of those decisions, and not to precipitate those decisions. So I think that you have sometimes, I used to say this a lot, is sometimes you have to go a little bit back and not watch your Bloomberg screen every minute or every second for the news that's coming out. Trump said this, the market is going down 3 or 4%. Sometimes you have to go back and say, but wait, let's see how things will go from now. Companies, 30 or 40% of the companies will not go bankrupt. Governments will not all go bankrupt. So the economy will survive. The economy will recover. So at some point in time, I think you need to stay a little bit calm, as and again, question your scenarios. Give probabilities to your scenarios, and then adjust your decision or your allocation to those scenarios. But it's not easy, honestly. It's not easy.
I'm just going to go through some questions here, because I believe there are some questions that were unanswered. Actually, there's a couple of them which I will answer myself. So we have someone who is asking if we have invested in any cloud startup. I imagine that's for ourselves. So yes, we did. We did invest in a cloud startup, and we have another member in the audience who is asking, how are your startup handling this downturn, and what changes have they made to handle this short yet sharp disruption in their businesses? So some of our portfolio companies were hit by this crisis, of course. The way they deal with it was it was very, very different, because they're in different industries, of course. Some of them pivoted their businesses. Cash flow management, so pretty much what companies can do. We give them a lot of support, of course. That being said, we actually have several companies in our portfolio who benefited from this pandemic, which is something almost not nice to say, but that's a fact. They actually benefited from this. I hope that answered the question. Yeah, so I'm just browsing.
I don't mind, Pedro. I don't mind answering a particular question about a country itself, but it's not the country. It's related to tourism, and
Go ahead. Yeah.
So it's more of a sector company. I think, of course, we talked about this. It's one of the hittest sectors, the sectors that got hit badly. Because I was saying, before we started this webinar, I was listening to you private. I was saying, I was speaking to a friend of mine who owns a hotel, and he said, I went from $100 of revenue to $0 of revenue, and no kind of picture on the medium term to, if I'm going to get back to, let's say, $60 of revenue in the next couple of months. I think, it will take some time for the tourism to get back. But I think, as I said, will depend a lot in terms of how the virus spreads itself. If I tell this virus thing, I tend to compare it to probabilities. And once again, if you're expecting to visit a country like, for example, Greece, or like Portugal, or like Spain, and you say, look, I'm gonna go spend 2 weeks of holidays in the south of Spain, for example, and the number of infected people in the south of Spain is 1, 2, 3, 0 for the past 2, 3, 4, 5, 6 weeks. Once again, what is the actual risk of you doing that? The probability of you getting infected is very, very low. Probably the probability of you staying home where you are in your town is huge, and the one so the question is, will people see this now? I think immediately no. But when you're confined at home for 2-3 months, I think you are eager to get out. You are eager to do that. You are eager to spend. I think to spend more. You are eager to have 2 weeks holiday, that you deserve to have 2 weeks holiday in a hotel, being Of course, the question of will you take a plane or not? Will you be on the plane? Once again, it will depend a lot on the experience that you have on the next couple of weeks. For the capability of the tourism recovery being more quickly or slowly in the next couple of months, it will depend a lot on this, because you see now, plane travels will open now in the beginning of June, so everyone will be fine. And even they were discussing having the planes only with 2/3 of seats occupied, and has finished already. They're going to occupy the whole plane. Of course, people wear masks. Probably, you'll have something like some companies already doing that. They're testing people before they get in the planes. And so I think all these kinds of measures are possible. But I tend to agree that the tourism sector will be probably one of the last sectors to recover. But I think governments are doing whatever they can, because as you know, most of the tourism, they depend on the summer. So you will have to avoid in having let's say, a lockdown of the tourism sector during the summer. And I think that probably happens. So I think we will see some recovery of the tourism during the summer. It will be probably slower, but I think then it will progress, and I hopefully positive on the next couple of months.
Take just one very last question from the audience. So somebody is asking if you see any potential to include crypto assets in the wealth management portfolio in the foreseeable future.
Well, that is a good question. No, not at all, honestly. And I'm not avoiding the question, but I don't think we still, well, you cannot have a currency that you cannot look at, at the cryptocurrency that has a huge volatility, and the ability for you to change, let's say real money for crypto money, and then crypto money from real money, you have to do this very easily. And I think it will have something to be, I think, for example, you look at the example, China now is thinking of, setting up their own cryptocurrency. I think it will probably take some months or maybe years to have a cryptocurrency that is really credible in terms of investment, let's say. On the other hand, maybe too conservative about my analyst background, but I tend to say that I found very difficult to invest in assets that do not have cash flow. It's like investing in gold. I always say that. I find it very difficult to have an opinion on gold or oil because it doesn't produce cash flow. A company produces cash flow, it has revenues, it has dividends. A bond produces cash flow, it has coupons, it has reimbursement. So I would say on a short to medium term basis, I say no cryptocurrency or no portfolios.
Actually, we're pretty agnostic regarding most industries that we invest in and even business models. But crypto is actually one of the exceptions. We just do not invest in crypto ourselves, in any crypto startups. Okay, that was very insightful, João. I think we should end this. We're already beyond time. Thank you very much for accepting and being here with us.
Thank you very much, Pedro.
Yeah. And I hope to see you soon. And thank you everyone for joining us today on this webinar. Like I said at the beginning, this webinar is recorded and will be made available at our website. So if you want to have a look at it again or share it with some friends and family, please do so. Thank you. Thank you, João.
Thank you very much. Have a nice day. Bye-bye. Bye.